This presentation entails the importance of insurance and how we can incorporate a strategy that meets your needs. From what I have gathered during our initial discussion, both of you would prefer to have a safety net in place should a serious accident or injury occur to either of you. The most obvious solution to this is an insurance policy, which is tailored to your individual needs. The ideal insurance plan is one that not only covers your medical bills, but also acts as a source of funds relative to the severity of a tragedy. Personal insurance is generally set in place to provide clients a peace of mind and lays a safety net which cushions them in times of disaster. Now, both Karunesh and Asha have requested for the different avenues of insurance. Karunesh wishes to have his insurance tied to super, while Asha wants hers outside of super. And we'll go through the viability of each option and their respective implications. Now, as Karunesh has stated that he wants his insurance in super, we'll go through the ins and outs of that. First and foremost, the insurance premiums are paid from your super account, not from your bank accounts. There is no direct link between the insurer and the client, so any proceeds are paid to the super fund first and then to the client. However, a member must meet the condition of release in order to receive the proceeds. The best part about insurance in super is that there is no added hassle of going through an underwriting process, unless you require additional cover for anything specific. Otherwise, you're automatically assigned the default cover. Now, as Asha requested recommendations for insurance options outside of super, we have considered that avenue as well. Unlike insurance tied to super, private insurance has its own set of processes, such as underwriting, now which insurance providers will use to determine how risky you are. You will have the option to customize your insurance plan and ensure that you are covered for your individual needs. Just please be aware that insurance premiums are much higher compared to that of insurance that is in super, which can cause cash outflow issues. Now we'll go through the benefits of each option. First and foremost, insurance premiums are cheaper as the insurance is grouped, and that's for insurance in super. Now, as mentioned earlier, there is no underwriting process involved, so neither of you will have to provide your medical records or go through a questionnaire. The premiums will be deducted from your super balance, so you won't have additional cash outflow problems, so that'll save up. The pricing options can be quite favorable if it's an employer super fund. It is considered a tax-effective way to pay for insurance premiums, as you pay it out of your concessional contributions. And the benefits of keeping insurance outside of super, the proceeds are paid directly to you. It doesn't have to go through a different channel. The insurance policy is portable as it's not tied to a super fund. Now, this falls in line with Asha's request, as she stated that she might leave her current employer. And the outcomes of both options. The outcomes tied to including insurance in your super are that you'll be able to manage your cash flow properly, as the insurance premium will be paid from your super account. And the additional funds from this strategy can be funneled into your investment portfolio, or it can be used to further augment your super accounts. Now, however, that paying insurance premiums out of your super funds, it will leave a dent in your retirement funds. And the outcomes of having your insurance outside of super. The increased cash outflow for paying insurance premiums will add an unnecessary strain to your savings and will keep you from exploring potential investments. And it will leave a big dent in your current savings. And there are certain risks for each option which you must consider before you pick one. And the factors that pose as risks for including insurance in super. The insurance policy expires at age 65 or 70. You will then have to acquire an insurance policy from an external provider. The lump sum payment, in case either of you suffer a tragedy, may be inadequate to cover the expenses tied to that tragedy. And processing the proceeds is slower compared to that of an external provider because it has to go to your super fund first, then it comes to you. Insurance policies are not portable if you change super funds. So if you change a super fund, the premiums paid during that, while you were in that super fund, will have gone to waste. The death benefits are at the discretion of the super fund's trustees. The major risk factor of having insurance outside of super is the premiums, which are paid using post-tax dollars. Now, it is a factor which can cause the most detriment to your financial situation. Premiums are subject to change at the discretion of the insurance provider, and usually they go up high. Now, I hope this presentation has been beneficial to you and provided the much needed insight into the world of insurance. Thank you.